Hello, everyone, and welcome to today's webinar on market insights for fixed income, where we will explore the key trends, opportunities shaping the fixed income landscape. I am Sandeep Solanki, product specialist, and I am joined by Mr. Anurag Mittal, head of fixed income, who will walk us through the latest market developments and provide valuable insights into the current state of the fixed income market. After Anurag's update, we'll open the session for Q&A segment. You are welcome to submit your questions throughout the webinar via the link provided. Let's dive into today's session. Over to you, Anurag.
Thank you, and welcome everyone to probably the last webinar of this calendar year 2025. It's been a very eventful year with a lot of macro developments, whether it's on the trade front with US and rest of the world, whether it's the tension between US, China, and of course the monetary easing pursued in this uncertain path. We also saw this month, this last week, RBI including its MPC policy and cutting interest rates by 25 basis points and also announcing various liquidity measures. So we'll cover some of the global key macro trends first, and then of course we'll take over the key takeaways from the RBI policy. So to start with, if you look at the overall global economic activity, and if you look at the left-hand side of the chart, which is JP Morgan Global PMI, which in which above 50 number represents expansion and below 50 represents contraction. At one point of time, if we see during March to June, probably 25, we saw the gap between services and manufacturing kind of narrowing as services had started to slow. At the same time, manufacturing was starting to pick up, probably as various importers decided to front load their requirement ahead of the tariff policy. So we saw that pick up in manufacturing, and now we are seeing some slowdown, although it still remains under expansionary territory, but yet there is certain excess capacity, and as the base effect of front loading has played out, now manufacturing seems to be normalizing. But if you look at services, that continues to remain quite strong. So despite all the news of AI-driven job losses, which we don't think still really happening, the wage growth continues to be quite stable. Global employment continues to be relatively stable, and hence we are seeing, overall services PMI being on a, I would say, steady wicket. If you look at the economic activity index also, which tries to quantify actual economic data compared to the consensus forecast, that also continues to be quite positive, which is broadly reflecting what most of the central banks, including the Fed, are also saying, that economic activity continues to grow at moderate pace. And the rate cuts that they are largely doing are insurance rate cuts to ensure that the pace of growth remains well anchored. On the commodity prices, commodities have had a very good year, especially precious metals this year. As we see in the month of November also, commodities continue to trend higher. Precious metals rose by 7.5% as central banks continue to buy gold to diversify away from their other FX holdings. That is also leading to rally in other precious metals like silver as well. We also saw strong demand for thermal coal, especially from China, and industrial metals remained steady during November. If you look at food prices, which is a positive news for India, global food prices moderated in October on broad-based decline in meat, dairy, cereal, and sugar prices. So broadly, if you look at the food price index trajectory, only during the 2022 early period, which was between Feb 22 to probably June 22, when the uncertainty due to Russia invasion of Ukraine was at its peak, and we saw a spike in crude as well as food prices. But since then, we can see a clear trend that food prices have been quite stable, supply has been ample, weather patterns have been good, and hence we also expect food prices to remain moderate in the coming months ahead as well. This table represents the bond yield movement on the 10-year sovereign benchmark during the month of November, which broadly reflects a very interesting global monetary divergence. So if you look at the US, for example, we saw decline in bond yields from 408 to 401 as expectations of Fed rate cut in the upcoming December monetary policy uh, increased. And if you look at Brazil as well, which saw a decline of 36 basis points, although on a higher base, broadly as US gave Brazil certain exemptions on its tariffs to really control own local inflation. So just to recap, Brazil, along with India, was hit by tariffs which were in excess of more than 50%. But as Brazil is one of the key exporters of coffee, meat, and some other products which saw high inflation in US after that, the administration decided to reduce tariffs on Brazil in the month of November, and that's when we saw some relief rally in Brazilian bonds. But if you look at rest of the table, uh, the the messaging was quite clear. As inflation expectations are starting to firm up, growth expectations are quite stable. We Most of the market participants expect central banks to either remain steady or hike rates at some point of time. There is also concern of fiscal excesses. So, for example, if you look at Japan, where because of the slowdown due to tariff issues, the government of Japan is expected to print a higher fiscal deficit. Same as the case in South Korea, Indonesia, etc. And that's why we are seeing some steepening of the yield curve globally. We are seeing a good amount of divergence where countries like US, probably UK, where rate cuts are still expected to continue, are seeing stable bond yields, whereas in Asia Pacific, where growth has been quite meaningfully constructive, there the expectations of monetary easing are coming to an end. This largely reflects US financial conditions, which is a big benchmark for global financial conditions. So if you look at the chart both on the left hand side, which is overall US conditions index measured by credit spreads, equity markets, bond valuations, etc. And the right hand side of the chart, which reflects market implied policy rate forecast, they continue to be quite sanguine. If you look at the right hand side of the chart, the market implied policy forecast saw a brief uptick in the middle of the November, but again saw a downtick as market participants increased their probability of rate cuts during the upcoming December policy, as many governors came ahead and spoke positively about their view on inflation, that they expect inflation to trend downwards. They also expect growth at some point of time to start trending downwards, and hence there is a greater confidence by market participants on the December policy rate cut, which we believe is largely in the price in the bond market. So now coming to the most important event last week, which was the RBI monetary policy. So compared to our expectations as well, the Monetary Policy Committee voted unanimously to reduce the policy repo rate by 25 basis points to 5 quarter and retain the neutral monetary policy stance. This policy was coming at a very interesting juncture. We saw significant depreciation pressures on rupee in the last 2 months as the earlier expectations of trade deal were getting postponed. So there was a certain section in the market which believed that RBI may not be able to cut policy rates, especially in line of rupee depreciation pressures, as the rate differential between global rates and local rates would continue to come down if RBI would have cut rates in this kind of environment. Moreover, we also saw the release of GDP data for Q2 of FY26, which printed above 8% compared to RBI's expectation of 7%. So there was also this expectation that given that growth is still way above market forecast, what is the reason of any rate cut? But RBI was quite clear that while growth continues to remain high for now, going forward, RBI does expect growth to slow down. So if you look at the chart on the right hand side, where RBI tries to project the growth for Q1 and Q2 of FY27. The growth is projected at 6.7 and 6.8, slight slowdown from the current levels. More importantly, the RBI focused on its primary objective, which is inflation targeting. So if you look at the current inflation forecast, so from a 1.8% inflation forecast for Q3 of FY26, now RBI is projecting just 0.6% inflation for Q3. And even if you look at fourth quarter of FY26, inflation is projected to be 110 basis lower than its earlier forecast of 4% to 2.9%. So broadly, if you look at FY26 average, that was already running at 2.6% forecast, which has been further reduced by 60 basis points to 2%. So given the comfort on inflation that RBI had, given the lower food prices, RBI believed that they are in a position to cut interest rates, and monetary policy should not be mixed with RBI's FX policy. So while on the FX side there is uncertainty on trade deal, there is a certain amount of FPI outflows that we are seeing, because of which we are seeing some pressure on rupee. But mixing these two separate issues, especially when domestic inflationary pressures are not there, would not lead to a right outcome. Because if you compare this situation to 2013 situation, in 2013, our local inflation was running at 10% plus. Our current account deficit was in excess of 4% of GDP. If we look at current inflation, that's projected to be 2% for FY26. If we look at current account deficit, it is expected to be around 1% of GDP, despite the trade uncertainty. So the macro outlook in 2013 and macro outlook in 2025 is very, very different. At that point of time, because of the taper tantrum in May 2013, we saw significant amount of FPI outflows in debt. And if we contrast that situation to current situation, we are in fact, despite these lower rates, compared to global interest rates, we are yet seeing debt inflows in the last 3 months, because inflation is expected not only to be stable in the current financial year, inflation is expected to be stable in the next financial year as well. In fact, in January 2026, Ministry of Statistics is expected to announce a new inflation series, which will be updated with latest household consumption patterns. So the weightages of food will further reduce, so probably the inflation will be marginally lower on a steady state basis and less volatile, because food tends to be more volatile. Also, because it will capture latest economic data points such as e-commerce sales, etc. Even some of the numbers on the core inflation side, especially on core goods, could be lower. So broadly, inflation is not only expected to be stable this year, it is expected to be stable next year as well. So in light of these circumstances, we believe RBI took the right call to cut interest rates, because what's more important, especially in these kind of times when the outlook on growth is slightly moderate and inflation is stable, that is the right time to cut interest rates and let interest rates cuts transmit into real economy. And that's where RBI was mostly focused at. So not only RBI cut interest rates, RBI also tried to address the liquidity concerns. So just to put things into perspective, currently the system is running at a liquidity surplus of about 3 lakh crores. If we expect RBI to even take delivery of certain FX forwards, so RBI is running a negative forward book of more than $50 billion. So if RBI were to take delivery of some of its immediate forwards, you assume a certain natural currency leakage, and you assume a certain CRR deployment as more deposits come into the system. By end of March 26, the current system liquidity surplus of 3 lakh crores is expected to get into a surplus of 50 to 70,000 crores. If we recall, RBI stated objective when they had cut CRR rates RBI stated objective was that they want to keep liquidity surplus to the tune of 1 to 1.5% of NDTL to ensure right monetary transmission. So if we were to take that number, RBI needs to keep and RBI needs to ensure that liquidity is surplus of more than 2 lakh crores even going forward ahead. So given the FX intervention that RBI has been doing in the last 2 months, given the maturity of its FX forwards book as well, RBI announced about 1 trillion in OMO and a $5 billion in FX buy-sell swap, which will release about 1.45 lakh crores in the month of December as well. So it's quite proactive because already in the month of December, around 15th of December, we will see some outflows due to advance tax, which will reduce liquidity from the banking system and increase government cash balance. We'll also see some GST outflow on 22nd December. So taking these measures was quite important, quite proactive, and it should help anchor the money market rates and bond deals as well. So RBI clarified that the OMO announcement should not be seen as a management of bond deals. It should be seen to ensure that there is adequate permanent liquidity in the banking system. So in a way, RBI can create liquidity only in two ways, especially on the permanent side, which is either through open market operations by buying bonds, which, when they buy bonds, they infuse rupee liquidity in the system, or by FX intervention when they buy dollars. So when they buy dollars, this sell rupee, this infuse rupee liquidity in the system. What they have been doing in the last 2 months is the opposite of that. They have been selling dollars to ensure uh, lower volatility in USD. So when they sell dollars, they take away rupee liquidity from the system, and hence we believe this 5 billion is a starting point. They may need to announce one more OMO of at least 1 lakh crores in the Jan to March quarter as well. They may need to do more buy sell swap to ensure forwards remain at reasonable levels, and your market yields remain quite steady. Having said that, we think probably this is the last rate cut in this monetary cycle, unless and until there is a major macro shock. So if you look at inflation forecast that RBI has put for FY27, for H1, if we take, which is expected to be around 4%, and if you take the current policy rate at 5 quarter, your real rate comes out to be around 1 quarter, which is very much in line with the 1.1 to 1.9% real rate range given by RBI. So even on a forward-looking basis, real rates seem to have reached at a lower bound. And if you look at the third quarter and the fourth quarter inflation probably of FY27, although RBI has not projected that for now, because of the base effect, because the current inflation is just zero point 0.6 and 2.9 for fourth quarter, next year second half inflation is probably likely to be upwards of 5%, just on the base effect. So from a overall steady state perspective also, we believe that the current policy rate is quite appropriate, given that the rise in inflation in FY27 will largely be base effect driven and not due to underlying factors. We think RBI will be able to maintain these policy rates lower for longer. So at least for the next 9 to 12 months, barring any major macro shock, we expect RBI to keep rates at current levels. We expect liquidity to remain quite steady. So in a way, this situation is just, like post-COVID situation where from 2020 till 2022, rates remained low. If you would recall, after cutting rates to 4% just post-COVID, from May 20 till Feb 22, RBI kept policy rate at 4%. So for almost 2 years, rates remained at 4%, and liquidity remained abundantly surplus. This is the scenario we are foreseeing in the next 9 to 12 months. That given lower inflation, and given that growth is likely to be moderate, we do expect RBI to keep rates steady. What if a trade deal happens? Will inflation pick up? Will growth pick up? And what will RBI do then? We think even if the trade deal were to get announced, probably this quarter or the next quarter, we don't think it will materially change the growth outlook going ahead. It will probably reduce further downside risk to growth because, as we discussed previously, India does not export a significant amount of goods to the US, but it does improve the sentiment. It does reduce downside risk to the growth outlook, but it does not change either inflation or growth outlook trajectory very meaningfully. So hence, we do not think even if the US trade deal were to happen, probably RBI will have to intervene less in the FX market. Probably USD INR will start to stabilize, but we do not think that it will necessitate any action from RBI on the monetary policy front. So this is the currency performance over this year and last month. So as we can see, rupee has been one of the weakest performer against the US dollar. And as we know this year, in fact, the dollar index has declined by 8%. So broadly, dollar has declined against major currencies. So as we can see in the tables, in fact, Russian ruble, for example, has outperformed dollar by 46% this year. South African rand by around 10%, so on and so forth. But rupee, Argentinian ruble, currency, and Turkish lira have underperformed dollar. So in these times, usually RBI is to intervene aggressively and try to reduce depreciation. This year, broadly, RBI has only tried to reduce the volatility and not the depreciation. So broadly, RBI has intervened to smoothen volatility rather than try to put a line in the sand that they want to protect a certain level, which is also logical because when you are facing trade uncertainty, when we are facing slowdown in growth, a weaker rupee, of course, helps exporters. So letting rupee find its own fair level does help exporters at the end, and also helps reconcile the trade deficit because, as we have been seeing in the last 3 months, as trade has been adversely affected for India, its current account has been widening, especially due to precious metals. So as rupee further depreciates, as imports become more expensive, exports become more competitive, it bodes well for India's trade account in the medium term. And again, just because the currency has been depreciating, RBI has not tried to change its monetary policy. Its monetary policy has rightfully been a function of domestic inflation considerations rather than a interest rate defense. Because if RBI were to mount an interest rate defense for rupee and make rupee interest rates really attractive for global investors, a 25 basis cut or a hold will not make a difference. They will have to hike interest rates at a much attractive levels to make rupee bonds more attractive for international investors. So this is the right view that RBI has been taking. RBI in these times of lower inflation has been trying to support growth, which should at some point of time lead to more FPI inflows, especially in equity once global trade situation stabilizes. So this is what I was talking about, and I was talking about RBI's benign neglect towards holding any particular rupee level. So if you look at the period between May till July 25, at that point of time, rupee saw some appreciation as well. So from all the way from 87 in April 25, it came to 84. So RBI let that rupee appreciate at that point of time, and since then rupee has been depreciating. And broadly, if you can see the trend, RBI has only tried to protect the intraday volatility, but it has not really tried to spend its FX reserves. So we have great amount of FX reserves of $686 billion, but they are only a deterrent if RBI uses them judiciously. Because if RBI were to really spend those FX reserves in defending a certain hypothetical level of rupee, which may not be true to its current, fair value, it only burns its FX reserves, which in fact could lead to more speculation on the rupee. So RBI has done the right thing. It has really tried to protect only the volatility. It has let rupee find its own value. And if you look at the chart on the right hand side, we think now INR is valued very attractively. So if you look at the 40 currency real effective exchange rate, so we tend to always look at rupee dollar because that's the most tradable pair. But if you look at India and its trade with 40 biggest partners, And if you take the weightages as per India's trade with those partners, and you take the real effective exchange rate for India was vis-a-vis those 40 trading partners and look at its historical average, in the last 5 years, India is way well below its 5-year average. So broadly, from a valuation perspective, we think rupee is trying to find its bottom. Probably once a trade deal is negotiated with the US and announced, we do expect pressure on the rupee to come off. We talked about how GDP growth was higher than expectations. So as we can see, GDP printed at 8.2%, which was well above all consensus expectations. The pickup was again quite broad-based. If you look at, for example, uh, the sectoral component of GDP, services continued to grow. They grew at 9%. And if you look at manufacturing also, that also grew at 9% from 7.7% in Q1 FY26. So there is also a certain technical factor to the high growth of services, because what happens in many cases is when the Ministry of Statistics does not have service inflation data, they use the WPI in many cases to deflate the services. So in many cases, especially when WPI is low, as in, for the Q2 of FY26 is almost close to zero. So your real service growth is basically your nominal service growth minus your deflator, in which this case was close to zero, and hence there was very less gap between your service real GDP and service nominal GDP, and hence you are seeing the gap reducing between your real GB and nominal GB, and hence we do expect the real GDP to slow down, because as the WPI picks up, probably we do expect growth to go more in line with RBI's estimate, which were close to 7% for the upcoming year. So as we can see from the table, the trade deficit is widening from 32.2 billion in September to 41.7 billion. One of the biggest factors was the gold demand. If you can see on the table, the gold imports picked up from 5.4 billion in August to 9.6 billion in September and to 14.7 billion in October, which explains 50% of the increase in trade deficit. One of the reasons was the festive season demand. So as we know, Diwali this year fell in October. So there was a strong pickup and strong demand for gold in September as well as in October. It remains to be seen how this growth pans out going ahead. But if you look at the trade X of oil and gold, even they are although widening, but the trade deficit is still quite moderate. So we do expect once the gold imports subside, probably the trade balance to go back to its historical levels. But if you look at the service exports, they continue to be quite robust. In fact, if you see the trend where we saw some slight dip in service exports to about 15 billion, but from August, September, we have been seeing steady pickup in net service exports as well. On the fiscal side, what we are seeing is low tax collections because of lower nominal GDP as well. So if you look at the corporation tax, it just grew by 5%. Income plus other taxes just grew by 6%. So what it means is, the government has had to reduce its revenue expenditure. So as you can see, the revenue expenditure largely was flat if you compare for the 7 months of FY26 compared to FY25. In fact, for October, the revenue expenditure was negative 8.2%. Even if you take excluding interest payments, revenue expenditure growth was just negative minus 5.4% for the whole 7 months. So not only for the October, outside of interest payments, the revenue spending by the government has been quite moderate. So we do expect whatever the shortfall in tax revenues, government will try to still maintain to its fiscal deficit target of 4.4%. So we do not expect the government to breach its fiscal deficit target. We do expect that the government will probably continue to cut down on spending and still meet its fiscal deficit goals for FY26. In fact, the capex should also shrink by 10 to 15% to ensure the government is able to meet its fiscal target, and hence we are also slightly negative on growth, because if Government capex has been one of the biggest driver of growth in the last 3 5 years. If government had to reduce its capex targets to meet its deficit goals, it could also have slightly marginally negative impact on GDP as well. Broadly on the credit growth, so RBI has been taking a lot of regulatory steps. They have reduced the risk weights of NBFCs. They have given certain liquidity benefits to the banks, and we are seeing those results now slowly gathering. So if you look at non-food credit, it has started to climb up compared to the deposit growth. So non-food credit growth remained steady at 11.3% in November 25 as well. If you look at the gap between credit deposit, it is widening. So if you look at the green and blue lines on the chart, at one point of time, those charts had converged. And now if you look at the green line, which is the credit growth, and the blue line, which is the deposit growth, that line since August 25 has started to widen, which shows that now there's a stronger demand for credit, and the demand is quite broad based. If you look at from an industry level, strong growth by micro and small enterprises, especially driven by positive steps from the government. You have agri growth, which is also quite strong, and then you have very strong demand from NBFCs for credit also for the disintermediation. So broadly, we do expect this credit deposit gap to remain wide for the next 3 to 4 months as banks pursue strong credit growth. But one of the flip side of that strong credit growth is also that to fund this credit growth and whatever cannot be funded by deposits, they will have to come to the market and issue bonds or CDs. So as they issue more bonds and CDs, you will probably see the spread between your overnight liquidity rate and CD rates widening in Jan to March quarter, and that could provide attractive investment opportunities for investors who are looking to invest beyond March. So as you get slightly higher spreads, as credit usually slows down in the first half of any fiscal year in the lean season, so to say, you should also see the benefit of lower spreads compared to March and probably some mark-to-market gains as well. So for investors who can look to invest beyond March, this they have to keep an eye on this credit deposit gap because it can really throw up exciting opportunities in the fourth quarter of FY26. On the yield curve, so as we can see, the yield curve continues to steepen. The 30, 40, 50-year segment continues to underperform the shorter end as the demand from long-term investors such as pension funds, insurance, etc., continues to moderate. So we are seeing this trend for quite some time now, and this is also reflective of typical late cycle. So as interest rates are closer to decline, typically we see flattening of the yield curve because investors at that point of time want to take the maximum duration. As rate cuts start to happen and we get closer to the terminal policy rates, investors tend to prefer shorter end of the yield curve because that gives them better risk reward, that gives them better visibility because the next port of call for them is when do interest rates reverse. So at these points of time, typically investors try to take an assessment, and hence in these times we tend to see 2 to 5 year segment outperforming the 30 to 50-year segment. We have been talking about the same for quite some time, and it's playing out, and we do expect even for next 6 to 12 months, curve will continue to remain steep. This is broadly the curve movement, trends. If we look at the T-bill rates as liquidity has improved, your 1 year T-bill rates have come down, your AAA yields have also come down. Even if you look at the 3 5 year GSEC rates or the corporate bond rates, that have also continued to improve broadly from compared to previous month. So again, on the outlook, just to recap, inflation continues to remain low. We expect inflation, both headline and core inflation, to remain moderate for the next 6 to 12 months. Growth momentum, while we saw 8% growth in Q2 of FY26, we do expect growth to decline as exports continue to get hit because of tariff-related uncertainty. We also saw when we discussed fiscal that how government will have to reduce its capex, which will also lead to some, you know, decline in capital formation growth. So broadly, we are seeing downside risk to growth in H2 FY26 and FY27. On the other hand, like we discussed during monetary policy update, RBI is trying to maintain certain liquidity to ensure that bond yields go down, loan rates go down, and hence we expect easy liquidity and a predictable forward guidance to ensure that the short to medium end of the yield curve will remain quite attractive. So we continue to remain constructive on moderate duration, which is the 2 to 5 year segment. Selective credit exposure to corporate issuers and well managed NBFCs, and we continue to be cautious on long duration as more supplies coming up in this segment. So broadly, I will stop here and then open the floor to questions. Thank you.
Thank you, Anurag, for running us through the whole presentation and sharing the insights. Let's move on to the Q&A. So the first yield difference between US and India is upwards of 3.3%. Why don't we have FPI inflows specifically in debt?
Thanks for the question, Sandeep. So we are already seeing a good amount of inflows in debt. If you look at our weightage has in fact reduced in the JP Morgan bond index from 10 to 9%. As the JP Morgan, they have added some other economies as well. But despite our reduced weightage, the debt inflows have been increasing. And not only because of rate differential. See, rate differential is one thing. Apart from rate differential, there is also a factor of currency outlook. So if investors can earn 3% higher than global rates, but they can potentially lose because of currency depreciation, then probably that economy tends to be less attractive to them. So I think it's a factor of not only rates, but view on currency, which is also a factor of FPI inflows in equity. So as we can see in the last 8-9 months, while gross FDI has been quite, in line with historical standards, net FDI has been low because of outflows in the equity market. So probably once currency stabilizes after conclusion of trade deal with the US, we should see more inflows in debt, resuming.
Okay. So the next question is, how do you see Fed's expected December rate cut influencing Indian bond yields and broader market dynamics?
I think the rate cut in December is largely priced in by the bond market. What matters for future bond outlook is the future trajectory of interest rate cuts by the Federal Reserve. So we are also expecting probably a change in the Fed chair next year, as the administration has mentioned that they want to change the current Fed chair. So it will depend on the incoming, administration of the Federal Reserve, that what's their view on inflation, what's their assessment whether this inflation, which is still above 3%, which is above their 2% target, warrants more aggressive cuts. So if the new, let's say, Fed administration were to cut rates aggressively, probably you will see short end of the yield curve in the US outperforming the longer end, because the longer end will still be subject to government fiscal outlook and long-term inflation expectations. So we do expect Fed to cut rates by 50 to 75 basis, but we do not expect aggressive rate cuts next year, because we do expect inflation to remain above 2% next year as well. So it will really depend on the inflation outlook really changing next year. So if inflation falls below 2% because of recession concerns or because of deterioration in labor market, probably we'll see more aggressive rate cuts than what's priced in by the market. If inflation remains above 2%, that gives very limited opportunity for Federal Reserve to cut interest rates, and probably it will not really have a meaningful impact on emerging markets as well.
Okay. All right. Thank you. So the next question is from Murli Krishnamurthy. So should one consider holding or exiting out of medium and long duration fund in the prevailing circumstances? What's your view on the same?
It depends on the investment horizon, it depends on the risk appetite, and it depends on the entry point of the investor. So if the investor had invested into these particular category, let's say a couple of years back, probably they would have seen decent returns due to the benefit of rate cuts. So it also depends on the investment horizon. So if it's a long-term asset allocation call for an investor, then probably they can stay put because a 4 to 7 year duration gives enough flexibility to fund manager during various interest rate cycles. And over a period of time, this segment can create decent value for the investor because it's able to capture the benefit of interest rate cycle by keeping higher duration at these points of time. So if it's a long-term asset allocation in debt, then probably one should stay put. If it was a tactical investment ahead of the rate cuts and now the rate cuts have played out, probably investor can consider moving into moderate duration segment like a short-term or a corporate.
Very well answered. So the next question is, with inflation now running below the lower threshold of target band, what are the key implications for the fixed income markets in the near term?
So fixed income market or the central banks largely look at two things when they consider inflation. One is the current inflation, one is the forward-looking inflation. So if you look at the forward-looking inflation, where RBI has given a forecast of 4% for first half of FY27, that's largely in line with RBI's target of 4%. So probably it doesn't call for any change in RBI's reaction function as long as inflation stays around 4. So if inflation were to go meaningfully below 4% in next year as well, then probably we can expect some monetary action from RBI. But if inflation continues to remain close to 4 or even go slightly above 4, then we should expect RBI to continue at these policy rates for a longer period of time.
Okay. So the next question is, how will the RBI's liquidity actions, such as OMO purchases and the USD INR swap, shape the yield movements and the overall curve behavior?
So one thing it does anchor the yields. So if you look at the bond market behavior of last 15 days, bond yields were rising because after the GDP print and after the fall in currency, it was expected that probably RBI will let bond yields also go up to give a signal uh, in terms of currency management as well. But RBI, like we also mentioned earlier, RBI has kept the monetary policy and the FX management separate. As far as the monetary policy and those liquidity measures are concerned, like we had discussed earlier, if RBI had not infused this liquidity, the system would have seen a certain tightness, especially at the time of advance tax in 15 December and GST outflow in around 22nd December. So hence, these measures have been proactive, and this should give support to especially the short to medium end of the yield curve, which is your 1 to 5. Because once this liquidity is injected, which is a durable liquidity, what it really does is that it helps anchor the overnight rate. It gives more space to the banking system, which helps them maintain money market rates or CD or bond rates also on a steady basis. So probably overall, by keeping money market rates anchored, it helps the management of the short end of the yield curve. On the long end, it's a function of multiple things. It's a function of what kind of stock selection does RBI do in its OMO. When RBI does execute the OMO, what is the proportion of buying of short end versus long end? So if RBI buys more on the long end, probably long end may also rally. If RBI continues to buy in the short to medium end, probably short to medium end will remain anchored. So it also depends on RBI's OMO strategy going ahead as well. But we do expect more OMO to come from RBI because as per liquidity requirements in the banking system, probably RBI may need to do OMO of more, about at least about 1 lakh crores in the Jan to March quarter. So we do expect bond yields to remain steady in this situation. I think more than the central government bonds, what also matters for bond yields in the fourth quarter would be the SDL supply. So if SDL supply is also on the higher side as some of the states are facing fiscal pressure because of lower tax collections. Probably that could lead to some long yields underperforming the medium term yields as well. So it depends largely on RBI's OMO, but it also depends on your the view on the upcoming SDL calendar for fourth quarter.
Okay. So we'll take one last question. In the current micro environment, what key risks should debt investors monitor and how should they position their portfolios accordingly?
I think whenever we are looking at any portfolio allocation, one always has to be forward looking and one always has to see risk to the view. So if we are looking at from next 6 to 12 months perspective, the current view that let's say the market would have is that probably, like I explained in the presentation, RBI is likely to keep rates lower for longer and likely to keep liquidity also on the easier on the surplus side. So what will really change this view? What will change this view on the adverse side will probably if inflation picks up because of adverse weather patterns, let's say food inflation starts to go up or growth continues to surprise on the upside, which leads to higher core inflation as well, which leads to RBI reversal much, much faster than what we are expecting right now, which is in the next 6 to 12 months. So the risk to the view is higher growth, or you have some adverse food price shock, which leads to higher inflation on the food side, which leads RBI to reverse its liquidity or monetary policy stance. So that's one risk that the investors have to really account for. Like I said, even if the US India trade deal were to conclude, we do not think it really changes the medium term macro dynamics for India. It doesn't change the medium term growth or inflation outlook. So probably trade deal is not the factor. It does improve the sentiment, it does improve rupee, but it's not really a risk to the trade view or the fixed income view. The risk that we are seeing is probably if growth continues to be at this point of 8% plus kind of levels, which is not the base case for us. Right? The third,
Right.
only the one also view possible risk is if currency continues to depreciate meaningfully. Probably right now we are not seeing any outflows in equity which are way above trend, but it could happen that you know outflows from equity or from fixed income could accelerate, which could also prevail on the bond market sentiment. But that's something like we discussed previously. We do expect trade deal to ultimately happen in the next 3 months. We think from a valuation perspective, rupee is quite attractive. So we do not see that as a base case.
All right. Thank you, Anurag, for answering all the questions, and thank you, participants, for being with us today. We hope Anurag's perspectives have offered valuable insights into the fixed income space and the road ahead. We look forward to connecting again soon. Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.